November 8th, 2022, 9:47 a.m. Twitter. Changpeng Zhao, known to the world as CZ, CEO of Binance, the largest cryptocurrency exchange on the planet, sends a tweet that will destroy a $32 billion empire in 72 hours.
Just moments ago, FTX filed for bankruptcy.
From a $32 billion company to bankruptcy in the matter of just 4 days or so.
And he's in big trouble. He's in big trouble.
The tweet is short, almost casual. Due to recent revelations, we have decided to liquidate any remaining FTT on our books. FTT is the native token of FTX, the world's second largest crypto exchange, run by Sam Bankman-Fried, the 30-year-old billionaire who has become the face of cryptocurrency, the golden boy, the savior, the man who promised to make crypto safe, legitimate, respectable.
I'm excited to be partnering with FTX.
If you're wondering, well, what is FTX?
FTX is like the best exchange.
They're a safe exchange where people can trade things like cryptocurrencies.
Within minutes of CZ's tweet, FTT's price begins to fall. Within hours, FTX customers are trying to withdraw their funds. Within days, FTX will collapse, revealing an $8 billion hole where customer money should be. $8 billion. Gone. Stolen. Used to fund risky bets at Sam's personal hedge fund, Alameda Research. But this isn't a story about a tweet. It's a story about a decision Sam Bankman-Fried made years earlier. A decision to blur the line between his exchange and his trading firm. A decision to use customer deposits as his personal piggy bank. A decision that seemed clever at the time, that made him billions, but that would eventually cost him everything. His company, his fortune, his freedom, and crypto's reputation.
Sam Bankman-Fried has been arrested in the Bahamas,
is being held in jail.
This is the story of how a MIT physics graduate, who claimed he wanted to save the world, built one of the most audacious frauds in financial history. How he convinced the smartest investors in Silicon Valley, the most respected institutions on Wall Street, and millions of ordinary people to trust him with their money. And how it all came crashing down in less than a week, taking $32 billion with it. To understand how Sam Bankman-Fried fell so far, you need to understand how high he climbed and how quickly. March 19th, 1992, Stanford, California. Sam Bankman-Fried is born to two Stanford Law School professors, Joseph Bankman and Barbara Fried. Both are accomplished academics. Both are deeply involved in effective altruism, a philosophical movement that argues you should maximize the good you do in the world through rational, calculated giving. Sam is brilliant, awkward, disheveled, but brilliant. He attends MIT, where he studies physics and mathematics. He becomes deeply involved in the effective altruism community, attending meetups, reading the literature, internalizing the philosophy. He's not interested in luxury or status. He drives a beat-up Toyota Corolla. He sleeps on a beanbag. He's a vegan. He's committed to the cause. After graduating from MIT in 2014, Sam takes a job at Jane Street Capital, one of Wall Street's most elite quantitative trading firms. Jane Street is known for hiring the smartest mathematicians and physicists and teaching them to trade. Sam is good at it, very good. Within 3 years, he's making millions in salary and bonuses. And true to his effective altruism principles, he's donating half of it to charity. But Sam is restless. He sees an opportunity that's too big to ignore. Cryptocurrency. In 2017, crypto is exploding. Bitcoin is hitting all-time highs. New coins are launching every day. And Sam notices something, a massive arbitrage opportunity between cryptocurrency prices in different countries. Bitcoin might be trading for $6,000 in the US, but $7,000 in Japan. Buy in the US, sell in Japan, pocket the difference. It's called the kimchi premium, and it's making people rich. In 2017, Sam leaves Jane Street and moves to Berkeley, California. He founds Alameda Research, a quantitative cryptocurrency trading firm. The name is deliberately boring, designed to sound like a research institute rather than a hedge fund. Sam recruits a small team of traders and engineers, many of them from the effective altruism community. One of them is Caroline Ellison, a Stanford graduate who also worked at Jane Street. She's smart, ambitious, and shares Sam's commitment to effective altruism. She'll eventually become CEO of Alameda and Sam's on and off girlfriend. Alameda is immediately profitable, wildly profitable. The arbitrage opportunities in crypto are so large, so obvious, that Sam and his team are making millions of dollars a day. Within a year, Alameda is managing hundreds of millions in assets. Sam's personal net worth is climbing into the tens of millions. He's 25 years old, but Sam sees a bigger opportunity. The problem with crypto exchanges is that they're terrible, slow, buggy, unreliable. They crash during high-volume periods. They have confusing interfaces. They're run by people who don't understand finance. Sam believes he can build something better, an exchange designed by traders, for traders, fast, reliable, professional. In May 2019, Sam Bankman-Fried and his co-founder Gary Wang launch FTX. The name stands for Futures Exchange, though Sam will later claim it doesn't stand for anything. The exchange is incorporated in Antigua and Barbuda, a Caribbean tax haven. By September, Sam moves FTX's headquarters to the Bahamas, another tax haven with friendly crypto regulations. Or, more accurately, almost no regulations at all. FTX grows at a speed that shocks even Sam. Within 6 months, it's processing hundreds of millions of dollars in daily trading volume. Within a year, billions. The exchange offers features that competitors don't: leveraged tokens, prediction markets, exotic derivatives. It's fast, it's reliable, and it's attracting the most sophisticated crypto traders in the world. But FTX's real innovation isn't technical, it's marketing. Sam understands something that other crypto founders don't. Cryptocurrency has an image problem. It's associated with scams, hacks, money laundering, drug dealers. If crypto is going to go mainstream, it needs legitimacy. It needs a face that people can trust. Sam makes himself that face. He appears on Bloomberg, CNBC, CNN. He testifies before Congress, advocating for sensible crypto regulation. He writes op-eds in major newspapers. He positions himself as the responsible adult in the room, the one who wants to work with regulators, who wants to protect consumers, who wants to make crypto safe. And it works. By 2021, FTX is valued at $18 billion. By 2022, $32 billion. Sam's personal net worth hits $26 billion, making him one of the richest people under 30 in the world. Forbes puts him on their cover. Time magazine names him one of the most influential people in the world. He's meeting with presidents, prime ministers, and heads of state. Sam is also donating massive amounts to charity and political causes. He gives $40 million to Democrats in the 2022 election cycle, making him one of the party's largest donors. He pledges to give away his entire fortune eventually. He's living the effective altruism dream. Make billions, give it all away, save the world. But behind the scenes, something is very, very wrong. From the beginning, FTX and Alameda Research are not separate companies. Not really. They share office space in the Bahamas. They share employees. They share bank accounts. And, most critically, they share customer funds. Here's how it's supposed to work. When you deposit money on a cryptocurrency exchange, that money is yours. The exchange holds it in custody, like a bank holds your deposits. When you want to withdraw, the exchange gives you your money back. The exchange makes money by charging trading fees, not by using your deposits. But that's not how FTX operates. From the very beginning, Sam gives Alameda Research special privileges on FTX. Alameda has a line of credit on FTX, a big one, Choice. He can admit that Alameda is insolvent, that FTX has a massive hole in its balance sheet, that customer funds are gone. Or he can keep the lie going, hope the market recovers, hope he can trade his way out of the hole. He chooses the lie. And he gets his entire inner circle to help him maintain it. Caroline Ellison, CEO of Alameda Research, will later testify that Sam directed her to commit fraud, to use customer funds for Alameda's trading, to lie to lenders about Alameda's financial condition, to create fake balance sheets that hid the true extent of Alameda's borrowing from FTX. Gary Wang, FTX's co-founder and chief technology officer, will admit that he wrote code that gave Alameda special exemptions from FTX's risk. Code that allowed Alameda to have a negative balance. Code that allowed Alameda to borrow customer funds without limit. Nishad Singh, FTX's director of engineering, will confess that he knew about the fraud and said nothing. He'll admit that he helped Sam make political donations using customer funds, millions of dollars in illegal campaign contributions, all to buy influence and avoid regulation. For months, the fraud holds. FTX's public balance sheet looks fine. Sam continues to appear on television, continues to lobby Congress, continues to position himself as crypto's responsible leader. In April 2022, FTX raises $400 million from investors at a $32 billion valuation. The investors include Sequoia Capital, one of Silicon Valley's most prestigious venture capital firms. They invest $213 million. They'll lose every penny. But the lie can't last forever, and it starts to unravel because of a single article. November 2nd, 2022, CoinDesk, a cryptocurrency news site, publishes an article examining Alameda Research's balance sheet. The article reveals something shocking. A huge portion of Alameda's assets are FTT tokens, the native token of FTX. In other words, Alameda's wealth is based on the value of FTX's own token. It's circular, it's fragile, and it raises an obvious question. If FTT's price falls, does Alameda collapse? And if Alameda collapses, does FTX collapse? The article sends ripples through the crypto community. People start asking questions. Why does Alameda hold so much FTT? Why are FTX and Alameda so intertwined? Is customer money safe? Sam tries to reassure everyone. He tweets that FTX is fine, that assets are fine, that there's no reason to worry. Caroline Ellison, in a bizarre move, tweets that Alameda would be happy to buy all of Binance's FTT tokens at $22 each. It's a bluff, an attempt to show confidence. It backfires spectacularly. November 6th, 2022, CZ, CEO of Binance, sees Caroline's tweet, and he smells blood. CZ and Sam have history. In 2021, Binance was an early investor in FTX, but the relationship soured. Sam bought out Binance's stake for $2 billion, including $529 million in FTT tokens. Now, CZ holds a massive amount of FTT, and he's about to weaponize it. November 8th, 2022, 9:47 a.m., CZ sends the tweet. Due to recent revelations, we have decided to liquidate any remaining FTT on our books. It's a death sentence. If Binance, the largest exchange in the world, is dumping FTT, everyone else will too. And they do. Within hours, FTT's price is in freefall. $22, $15, $10, $5. And as FTT collapses, so does Alameda's balance sheet. And as Alameda collapses, so does FTX. Customers panic. They try to withdraw their funds from FTX, but the funds aren't there. They're gone. Used by Alameda, lost in bad trades, spent on real estate, venture investments, political donations. FTX processes some withdrawals, but it can't keep up. The exchange is hemorrhaging money. November 8th, 2022, evening. Sam reaches out to CZ. He asks if Binance would consider acquiring FTX, bailing it out. CZ agrees to look at FTX's books. It's a stunning reversal. Just days ago, Sam was worth $26 billion. Now he's begging his rival for a lifeline. November 9th, 2022. Binance announces it has signed a non-binding letter of intent to acquire FTX. For a few hours, it seems like FTX might be saved. But then Binance's team starts examining FTX's financials. What they find is catastrophic. The $8 billion hole, the commingling of customer funds, the loans to Alameda, the fake balance sheets. November 9th, 2022, evening. Less than 24 hours after announcing the deal, Binance walks away. CZ tweets that FTX's issues are beyond our control or ability to help. It's over. November 10th, 2022. FTX halts all customer withdrawals. The exchange is frozen. Billions of dollars in customer funds are trapped. Sam tweets a thread trying to explain what happened, promising to make customers whole. No one believes him. November 11th, 2022. FTX files for bankruptcy. Sam Bankman-Fried resigns as CEO. In his resignation letter, he writes, "I'm sorry, that's the biggest thing. I fucked up." The letter is informal, almost childish. It does nothing to help the millions of customers who have lost their money. The collapse of FTX is the fastest destruction of wealth in modern financial history. In 72 hours, a $32 billion company is reduced to nothing. Sam's personal net worth goes from $26 billion to zero. But the story doesn't end with bankruptcy. It ends with handcuffs. December 12th, 2022. Bahamas police arrest Sam Bankman-Fried at his luxury penthouse in Nassau. He's charged with wire fraud, securities fraud, money laundering, and campaign finance violations. The US government accuses him of orchestrating one of the biggest financial frauds in American history. Sam is extradited to the United States. He's released on a $250 million bond, the largest pretrial bond in history, secured court in Manhattan. The prosecution's case is devastating. They present evidence of the $8 billion hole in FTX's accounts. They show how Sam directed Alameda to use customer funds. They reveal internal messages where Sam and his team discuss how to hide the fraud from regulators and investors. Caroline Ellison takes the stand. She testifies that Sam directed her to commit crimes, that he knew exactly what was happening, that he made the decisions. She describes how Sam would rationalize the fraud, claiming that the ends justified the means, that making money to donate to effective altruism causes made the fraud acceptable. The defense tries to argue that Sam made mistakes, but didn't intend to defraud anyone. They claim he was overwhelmed, that he relied on others to manage the details, that the collapse was caused by a market crash, not fraud. The jury doesn't buy it. November 2nd, 2023. After just 4 hours of deliberation, the jury returns a verdict, guilty on all 7 counts. Wire fraud, conspiracy to commit wire fraud, securities fraud, conspiracy to commit securities fraud, money laundering. Sam shows no emotion as the verdict is read. March 28th, 2024. Sam Bankman-Fried stands before Judge Lewis Kaplan for sentencing. The prosecution asks for 40 to 50 years. The defense asks for 5 to 6 years, arguing that Sam is a first-time offender who acted out of misguided idealism, not greed. Judge Kaplan is not sympathetic. He calls Sam's testimony during the trial evasive and misleading. He says Sam showed no remorse, no acceptance of responsibility. He sentences Sam to 25 years in federal prison. At 32 years old, Sam will be 57 when he's released. His entire adult life, gone. The FTX collapse didn't just destroy Sam Bankman-Fried. It destroyed trust in cryptocurrency. For years, crypto advocates had argued that digital currencies were the future of finance. Decentralized, transparent, free from government control. FTX proved the opposite, that crypto exchanges are just as vulnerable to fraud as traditional financial institutions. Maybe more so, because they're less regulated. The collapse triggered a broader crisis in the crypto industry. Lending platforms like BlockFi and Genesis filed for bankruptcy. Investors pulled billions from crypto funds. Bitcoin's price, which had already fallen from $69,000 to $16,000, stayed depressed for months. The total market capitalization of cryptocurrency fell from $3 trillion to under $1 trillion. But the collapse also led to change. Regulators around the world took notice. The US Securities and Exchange Commission brought charges against multiple crypto companies for operating unregistered exchanges. Congress held hearings on crypto regulation. The industry, which had operated in a legal gray zone for years, was forced to grow up. And FTX's customers, some will get their money back. In 2024, FTX's bankruptcy estate announced it had recovered enough assets to pay back customers in full, plus interest. But that's only because Bitcoin's price recovered. If Bitcoin had stayed at $16,000, customers would have lost everything. Sam Bankman-Fried's story is a cautionary tale about the dangers of unchecked ambition, rationalized fraud, and the seductive power of ideology. Sam convinced himself that stealing customer funds was acceptable because he was going to use the money to save the world, that effective altruism, earning to give, justified any means necessary. You can't save the world by lying. You can't maximize utility by destroying trust. Sam didn't just fail at effective altruism, he perverted it. He used a philosophy about ethics to justify the most unethical behavior imaginable. The FTX collapse raises uncomfortable questions. How did Sam fool so many smart people for so long? How did Sequoia Capital, one of the most sophisticated investors in the world, invest $200 million without discovering the fraud? How did regulators miss the commingling of customer funds? How did auditors sign off on FTX's financials? The answer is that Sam was very good at playing the game. He knew what investors wanted to hear. He knew how to present himself as the responsible adult, the one who would work with regulators, the one who would bring legitimacy to crypto. He cultivated relationships with politicians, journalists, and thought leaders. He donated to the right causes. He said the right things. And everyone wanted to believe him. Because if Sam was right, if FTX was the future of finance, then getting in early meant making billions. Greed made people gullible. Hope made them blind. Today, FTX is gone. The Bahamas headquarters, a luxury penthouse where Sam and his inner circle lived and worked, sits empty. The FTT token, once worth $22, is worthless. And Sam Bankman-Fried, the boy genius who was going to save the world, is imprisoned. But the lessons of FTX remain. Don't trust charisma over competence. Don't trust promises over proof. Don't trust anyone who tells you the rules don't apply to them because they're special, because they're smart, because they're going to change the world. And most importantly, don't trust anyone who uses philosophy to justify fraud, because when someone tells you they're stealing for the greater good, they're not a visionary. They're just a thief with a better story. That's the $32 billion lesson, and crypto learned it the hard way.